I'm Jessica Minton for IB Times TV, and I'm here on the floor of the New York Stock Exchange, where stocks fell today on concern about global economic growth. Jobless claims fell by the most in 4 years, but it did little to help concern about a global economic slowdown. Kenneth Polcari, who's the managing director for ICAP Equities, is going to be speaking to us about this jobless claim data, as well as the latest minutes from the Federal Reserve's June policy meeting. The U.S. trade deficit narrowed slightly in May as lower oil prices and a rise in exports, including those bound for Europe and China, eased the pain of a slowdown in the broader economy. But economists cautioned the strength in exports was likely to decrease, given the weight Europe's debt crisis was placing on the global economy. Data showed that the U.S. trade deficit narrowed in May. How long do you think that can continue?
I don't necessarily think it's going to continue very long. Listen, tomorrow's going to give us a very big clue on what's happening in China. They're waiting for their GDP number, which they'll report overnight tonight. All eyes are in the fact, or all ears are really listening to the fact that China is starting to slow down even more extensively than people thought. That being the case, I think we're going to see a problem there. So I don't think I think so. Then it's going to affect Europe, and it's going to come back and affect us more than it already is. So I suspect that we're not going to see that go on for much longer.
The Labor Department reported on Thursday that new claims for state unemployment benefits dropped 26,000 last week to 350,000, which is the lowest since March 2008. The 4-week moving average, which normally provides a better indication of the underlying trend in labor markets than the weekly number of jobless claims, made a significant drop, but the average is only at its lowest point since May. The number of Americans filing new jobless claims fell last week by the most in 4 years. How do you think that psychologically affects the markets?
You know what? It's interesting because you would have thought a number like that, if it was people thought it was a really good number, you would have seen much more activity in the market today. You would have seen more strength in the market. You would have seen people really stepping up to buy stock. In fact, I think all it says is that there are less people who claimed, which may look like it's a better number because the number's lower, but all that means is that people are frustrated. They can't get a job, and they've fallen off the rolls, and so therefore they're not counted anymore. And that's what you have to be careful about, because all the data really suggests that unemployment, job creation is not happening in this country, and so to see a drop in the initial jobless claims is not necessarily viewed as a positive, and that's what the market's telling you, because the market does not see that as a positive number today.
Minutes from the last Federal Reserve meeting showed policymakers are open to the idea of providing more economic stimulus, but that conditions might need to worsen for consensus to build. At its June meeting, the Fed announced that it would buy an additional $267 billion in long-term bonds with proceeds from short-term notes, but it didn't embark on another round of quantitative easing to stimulate the economy. The minutes from the Federal Reserve's latest policy meeting showed that major central banks are skeptical about more easing. What are you predicting will happen?
Well, we've seen almost every central bank around the world come up with a program between last week and this week, right? The only one who hasn't yet is us. And in fact, we really did, because in June, we extended the current program, Operation Twist, which isn't really what the market wanted to hear. Our market wants to hear that the Fed wants to pump more money into it. And in fact, I think the best thing for the Fed to do at the moment is to sit back, right? We've got this program in place. The market has to kind of find its own level. Now, if we fall completely off the edge because Europe falls off the edge or China falls off the edge, yes, then the Fed should jump in. But barring that, I really think the Fed needs to kind of sit back and let it wait. And so I'm glad on a certain level that the Fed did not come out with another stimulus program, because if you've noticed, all we really see when that happens is the market has this initial surge up, and the minute the program's over, we roll right over and we're back down again. And so the fact is, monetary stimulus does not fix the structural and fundamental problems in the economy, and that's a job that Congress and legislators and leaders have to do. They've got to start to incorporate fiscal policy initiatives with monetary policy initiatives in order to really turn this economy around. So monetary policy alone is not going to handle it, and I'm on the camp saying that I don't think they should unless we really fall off the edge, and I don't think that's going to happen.
Tomorrow, investors will be looking towards second quarter GDP data from China for an indication of the nation's economic health. I'm Jessica Minton for IB Times TV, reporting from the New York Stock Exchange.